So we are looking at planning for future financial security. And the lesson, the objectives for this lesson. By the time we are done with this lesson, we should be able to explain reasons for saving and where to save, and also analyze factors to consider when selecting a saving institution. And then you explain the concept and principles of insurance, describe the types of insurance, and explain the term investment and the reason for investing, and also analyze the different forms of investment. Now, with the lesson overview, good financial management means looking ahead into the future, and that is important to remember that there may be a time when an individual can no longer work, and yet he or she still have to provide for his basic needs. Because of this, we all need to plan for financial security, which involves the individual's ability to manage his or her income, to meet present and also make provision for future. So this can be achieved through savings, investment, and insurance. So basically, these are the three main things we are going to look at: savings, investment, and then insurance as a means of planning for our future financial security. So savings, Patience, can you talk to us briefly anything you know about savings? When you hear the word savings, what comes to mind? This is a general question or savings. I'm not restricting you to the topic now.
Okay, madam. Madam, saving is like you save some money down for the future in case you are in need of something. You can pick it, you can go for the money and do whatever you want to do with it.
But you still use the word savings in explaining savings. So it's simply putting something aside for the future.
But that means simply keeping something.
You keep something for future use, or you put it aside. So the word savings just means keeping something for future or something to be used another time. Now, savings result from the careful management of income and expenditure so that there is some left to save for the future. So whatever you receive as income, you must not spend all. You need to reserve some and then you save. Remember our previous lessons when we discussed budget, we said a very good budget must have savings as one of the items in the budget. So it's just a continuation of the whole unit we started. We handled income, and now we are looking at how to plan for our future financial security. And we said that savings is a way a family or an individual can put something aside for future use, or keeping something for future use. So in terms of money, it means you are keeping money or you keep money aside for future use. So anytime you receive any income at all, you have to manage it carefully so that after you spend, you leave something aside so that you will not be found wanting in times of need. So we'll proceed and look at reasons for saving. Ruth, why will you save money?
Madam, for emergency.
Okay. Can you give a specific example of an emergency that will call for saving money? Hello, Michael, you are welcome. Okay, an emergency that will
Thank you.
saving money can be taking somebody to the hospital. Just, sickness will not inform you that on this day, on that day, I will visit you. So you need to save so that when a member of the family is sick, that person can be taken care of. Or there's an urgent need to be taken care of. It could be an accident have just occurred. You need money to take care of the situation. It is money that you use to take to the hospital. And then two, we can also save for a particular goal or goals, such as paying of children's school fees, buying a house or buying a land, buying of a furniture, any expensive item, you can plan and then save towards it. For instance, as a student, as a food and nutrition student, you can plan towards buying a bigger oven and then a deep freezer. So as you are in school, the little money you are giving right from first year, you started saving some money because you had a goal in your mind that before I complete SHS, I need to have my own oven that I will be using to do a little business whilst I wait for my results. So that is also a reason why you can save. Remember, the goal could be a short-term goal or a long-term goal. You can still save towards that. And then three, you can also save for investment, such as building an estate or starting a farm or a business or trading, or you want to increase your wealth. So you can save and then you put the money into an investment fund. It's also a reason why somebody will save. Then we can also say that as the only income for earning, as the only income after earnings decline or ceases as a result of retirement or loss of job, you need to save so that at the time when you can no longer work, you have something to depend on. That is when you go on retirement or when you lose your job, you have something. Let's just take this few months that we have experienced from March up till date. If you had not saved anything when this lockdown or this coronavirus came, a lot of people have lost their jobs. If you had saved something, you can use that money to run another business so that you can take care of the needs of the family. I hope that is well understood. The reasons for saving. One, we said to meet emergencies, such as taking a sick person to the hospital. We also said to meet a particular goal, such as buying a refrigerator, buying a furniture, paying of fees. And then we also said you can save for investments. You can save for investments into either building or starting a new business or as a form of increasing your wealth. And then we can also say, we also said that one of the reasons for saving is that when you save during your youthful ages or the time you are able to work, when the time comes when you can no longer work or when you go on retirement, you have something to depend on. These are few reasons why we save money. Now, ways of savings. we can talk about the formal and then the informal ways. Now, we save through personal accumulation of funds. That is by putting your money into a venture that can earn you an income. And this can either be formal or informal, that is accumulation of funds. When we go to the villages, people will just keep profit from goods they have sold under their pillows as a way of accumulating funds or keeping the money, so that when they are in difficulty, they just go there. So that becomes like a bank, which is an informal, that is saving at home, which is an informal. Now, the various ways in which employers save money for the future for their employees are through pension, superannuation, and then social security schemes. And then another way of saving is through the insurance scheme. So when you buy a policy from an insurance company, it depends. Some of these policies can be used as savings. It depends on the type of policy you buy. So these are just ways you can save money. So first of all, we said personal accumulation of funds, which you can use and then you put into a venture. It could be any business. Then we also said that employers also save money for the future of their employees through pension schemes and then social security schemes. And we also said another way of saving is through insurance schemes. Now, let's look at some factors to consider when you are choosing a savings institution. Things you have to take into consideration before you choose a saving institution. One, safety. That is freedom from danger or risks and assurance of getting the money you have deposited back. Anytime you want to choose a savings institution, ask yourself, this particular institution, is it an institution that after saving with them for years, I'll just go there one day and find a very big padlock used to lock the entire office? Or you pick a phone to call and then nobody answers, means your money is not safe. But in a situation where your income is saved, it means that that particular savings institution is an institution that Bank of Ghana have given them the accreditation to operate. Yes, Michael. Hello, Michael.
Madam, please, madam,
Yeah, I can hear you.
madam.
Yes, I can hear you. Michael, go ahead. I can hear
Yes,
you.
I can hear you.
Okay.
Madam, please, in situations where some banks collapse, and then the people who have invested their money in the banks, yes. So how will we know if I'm going to invest in a bank? How will I know that the bank can guarantee safety? Like that, there will not be collapse of the bank.
You see, banks that are accredited by Bank of Ghana, when you enter there, you see a certificate of accreditation. But what is happening currently that the banks have been closed down, they are not able to meet the minimum requirements. It doesn't mean that customers saved with them when they did not know that these banks had issues. The national issue that is happening is an example, because if you knew that this is not a reliable bank, you wouldn't have paid any money into that bank and say you are saving or you are investing in any, you are doing any sort of investment with them. So that is the safety aspect of the banks. You see, a lot of monies are locked up. Customers have their monies locked up in a lot of banks because of these issues. And even some of these banks had their accreditation all right, but their license have been revoked because they are not able to meet the minimum balance. Have I answered you? Hello, Michael. You asked the question.
Yes, madam.
Okay. So that is about the safety. If you enter any of these commercial banks at all, being it Zenith, Stanbic, GCB, Societe Generale, they all have that kind of license notice or certificate in the banks. You see them in the banking hall. If you have not noticed it, the next time you enter any banking hall, check for that certification. They just make it like a frame and then hang there. Then another factor you need to consider is liquidity. When we talk about liquidity, it is the ease and speed of converting savings deposit into cash. So this company that I'm going to save my money in, will I be able to get my money anytime I request for it? That is another critical question you need to ask when you are selecting a savings institution. That is liquidity, or they'll keep tossing you, come today, come tomorrow, and you just be wasting transportation here and there. Then the third one is yield. Yield, returns or profit, usually expressed as interest or dividend, then customary calculated as percentage of the amount deposited. The place where you are going to save your money, what kind of profit is it going to yield? Sometimes you have to weigh it. If the dividend or the interest is too exciting, you have to take a second look at it. For instance, you chose a savings institution that the yield or the interest that they claim will accrue on your investments is 100%. That calls for a second thought, because if they give that kind of high yield, you ask yourself, what at all are they going to use the money for that can earn you multiples money? If you are not careful and then you are enticed by that, you save in that for the first 3 months, you may get it. Then subsequently you go there and then you realize that that kind of group is a fraud or something. So it's important that you take these factors into consideration when you are choosing a savings institution. The safety of the institution, liquidity, and then yield. Or will it just, the yield, will it just be an institution that you save there for several years and the only interest that will accrue on your investment is just 1 Ghana, 2 cedis? If you had invested that money into another business, which would have yielded something better for you, would have been better than just accumulating the funds. So these are some of the factors that you need to consider when you are choosing a saving institution. Now, where will you save? Where to save? So we are going to talk about the two main ways. That is the informal institutions and then the formal institutions. When we talk about the informal institutions, we can talk about some of these savings and loan societies, the susu clubs, welfare societies, or the working banks. And then when we talk about the formal institutions, we are referring to the commercial banks, the rural banks, the insurance companies, and then the credit union. So we are going to take this one by one.
Madam, please, which one is the working bank? Example.
Yes, we'll delve into that right now. We'll start from the informal institution. Then you get to know what the working bank is. In fact, since you have asked that question, let's rather start from that. Now, the working bank is an example of an informal institution. Sometimes when you go to the market, you see people walking around with a very big notebook or foolscap notebook, and then small cards. On either daily or weekly basis, these people go around, collect the money. You see, the card is made in such a way that it has the dates of the month, being it 30 or 31 days. So the contributor, if you are a contributor, the person who is working to you or the client comes to you, take the money, and then will tick on the card. So you will keep your card, and then he or she records it in that big book that he's going around with. So at the close of the day, he or she submits that money or pay that money into his account. You do this for a whole month. Then at the end of the month, it's just the amount you have contributed minus one day's money. So for instance, if you contributed 5 cedis for 31 days, you will be paid 5 times 30 days. That one day will be used as service charge for the person who went around and then collected the money. That is how the working banks operate. So it's normally one person. That person goes around, collect the money either on weekly or daily basis, send the money to the bank. Then at the end of the month, he pays you the total amount you have paid less one day's contribution. So for instance, if you are contributing 10 cedis on daily basis for 31 days, that is going to be how much? 310 cedis. 310 cedis. But you will be paid at the end of the month, you will be paid 300 cedis. So the 10 cedis will be the service charge for the person who goes round to collect the money. That
So,
is
madam,
how,
please, there's no profit.
no, there is no profit at all. That one is just accumulation of funds. You are just accumulating funds. The amount you pay, that is how much you receive, less one day's contribution. Any question about the working bank? So that is an
No.
informal.
No.
Okay, that is an informal way of saving money. So now let's talk about the susu groups. The susu groups. The susu groups also operate differently. There is one that you can be 10 in a group. Then you all have specific amounts that you contribute. Let's assume you all contribute 100 cedis each month. So you are 10 in the group. It means at the end of the month, 10 times 100 is going to be 1,000 cedis. That money will be given to one person in the group. The following month, another person takes it until all the 10 of you get your 10 to receive the 1,000 cedis. That is one way that can be done. And then if you are in desperate need of money and then you want to take before your 10, depending on the agreement the group has come with, you can swap with somebody and then you are giving the money before your 10. And that may or may not come with an interest, depending on the terms that the group have come to. So that is one aspect of the susu. Are you clear with that one too?
Madam.
So this one too, there is no interest.
Madam.
Yes.
Madam, please, is there any written agreement for this one? For
Since
yes.
it is informal, it depends on the people who are running it. There can be a documentation, but because it is informal, when there's a problem, we'll be coming to the limitations. When there's a problem, who are you going to report to? Because who was there when that agreement was made? So when we get to the limitations or the disadvantages, you see the other side, the disadvantage side of it too. Because you can contribute for somebody after he has collected his money, he may not pay for the next person. So these are some of the limitations that this informal way of savings may have. We can also talk about another one, keeping money at home, like the first example I cited. There are some people who don't trust the banks. They don't trust the bank at all. So instead of them keeping money at the bank, they prefer to keep it at home. So some traders and then some farmers in the rural communities, they utilize this means to save, to build, and also to expand their businesses or to farm and to meet emergencies. And they feel it is convenient for them because anytime they need their money, they can go for it. Somewhere last 2 years or so, there was this story about an old woman who said she kept her money with some savings and loan company, and then the company collapsed, so she lost her money. So the next thing she did was tie the money in rubber, dig a hole, and then kept it. Unfortunately for her, she went when she was in need, and termites have chewed almost half of her money. So there can be a lot of risks involved in keeping the money at home. Should there be theft cases or robbery case or fire outbreak, you lose everything. But when you keep your money in the formal sector, that is the bank, and then there is even fire outbreak, the bank will not tell you that your money got bent. They will recover your money back for you. That is the liquidity we spoke about when we're talking about savings. The factors you consider when you are choosing a savings institution. Then we can also talk about welfare societies. Welfare societies. Now, the main purpose of welfare societies is to assist one another in times of need. And dues of fixed amounts are contributed by the members, and these sums are kept by a treasurer. The maximum amount of cash to be given as loans to members is usually determined by the group, and members do not actually pay interest on the loan. It depends. Maybe you can form an association, and then you say you are contributing money to help one another. so that if one person is in need, the person can take a loan. You decide as a group whether it is interest-free or there should be an interest on it, so that any member of the group who is in need can take the loan, and then you use the rules and regulations governing the welfare society to run the society. That is also another means of savings. So what this means is that you are a group, you save. At the end of the financial year decided by the group, you all share your money. But along the way, let's assume the financial year is not ended, but you urgently need money. If it is the policy of the welfare society that, okay, you can take part of your contribution as loan, then it is given to you. Again, if it is part of your policy as a society that, well, whatever loan you take, there will be some interest on it, so that at the end of the financial year, that interest is shared for all members. That too can be done. So as the welfare society, you as a group need to come up with rules and regulations that will govern your welfare society, or you must have a constitution. And all this is informal, but although it is informal, it has some documentations backing it. Unlike the SUSU also have a bit of a documentation, but keeping money at home, it is your own money. You can choose to keep records or not. So these are some few ways we can keep or save money informally. And remember, most of these informal means of savings doesn't have interest on it. It's just a way of accumulating funds. It's just a few that if they have the loan system where members or even non-members who take the loan are asked to pay interest on the loan, they may get some form of interest on their savings. But apart from that, all the others we discussed earlier on is just accumulation of funds without any interest. Any questions so far before we continue?
No.
Okay, now let's look at the
No, madam.
limitations. Let's look at the limitations or disadvantages of these informal institutions. Yes, like I said earlier on,
Madam,
members, yes.
madam, please, your voice is down. Oh.
Okay. Some members of a SUSU group may not pay their contributions. You see, the SUSU group we discussed earlier, they take the money in turns. The example I cited, you are 10 in the group. At the end of January, the first person received his or her 1,000 cedis. February, the second person received. Then March, the third person is supposed to receive. The first two people who have already received their money refuse to pay. It becomes a problem. They have already received, instead of them to pay so that the other contributors will also get their money, they have refused. Another disadvantage is that with those who deal with the working banks, they collect at the end of every month, you get your money. And then, unfortunately for you, on a particular month, the month has ended, you were waiting for the person who comes around to collect the money to bring your money. You waited days, weeks, months, that person is not coming. You start calling that person's line, the phone is off, not available, cannot be reached. You go to the person's home or residence, You realize you were just told, oh, he have relocated to an unknown place. That is a worry or an advantage of the working bank. And it is risky to keep huge sums of money at home. Like I said, you are keeping that huge sum of money at home. There is fire outbreak. All the money is bent. You have lost. Or you kept that huge sum of money at home, and unfortunately, armed robbers attacked your home. They broke into your home and everything was taken away. You have lost. So all these methods, another disadvantage, all these methods we spoke about do not yield any interest. Rather, if you look at the working bank, you will rather lose one day's money. So these are some of the disadvantage or the limitations of informal means of savings. Any question?
No, madam.
Okay. Now let's proceed and look at savings with the formal institutions. Savings with the formal institutions. Normally, we can talk about the commercial banks and then the rural banks. Please, when we talk of commercial banks, we are not referring to only GCB. GCB, that is their name. But all the other banks, they are all referred to as commercial banks, like Societe Generale, Stanbic Bank, Zenith Bank, Agri Development Bank. They are all commercial banks. So let's look at some of the accounts that are operated by these banks. First of all, we'll talk about current accounts. Current accounts does not earn any interest, but rather you, the owner of the account, or you, the account holder, you pays the bank some charges for operating your account. So if you are operating a current account, people normally call it salary account because that is where salaries are paid. And then the bank will never allow that salaries should be paid through savings account. That is the reason why some people call it a salary account. So the current account, it doesn't generate any interest, but you, the account holder, will be charged for services that are being rendered for you. And also with the current account, you have the opportunity to be given a checkbook. And the checkbook bears your name. And that checkbook, the check leaflet, you can either use it to cash money or to pay debt if only the customer is ready and willing to accept the check. Now, the checkbook is used for operating the current accounts. Then we have another account which is called the deposit account or the fixed deposit. With that account too, a fixed amount of money is deposited at the bank for a fixed period of time. It could be 3 months, 6 months, 1 year or more. It depends on the bank, how they have arranged that. And a fixed rate of interest is paid on the money at the end of the period. So that one will accrue some interest, but the interest is fixed. So if from the beginning you were told that the interest for the money you are depositing either for 3 months or 6 months is going to be 5%, it is the same 5%. There wouldn't be any change. If it is 10%, it is the same 10% interest you will receive. There wouldn't be any change. So neither the full amount of the money nor part of it can be withdrawn before the end of the stated period. So if you deposited that money or the fixed deposit was made for 6 months or 1 year, until the end of the term you came into agreement with, being it 3 months, 6 months, or 1 year, you cannot go and say, hey, I need some money, let me take part of it. You cannot. The money must remain there until the stated period. So when the stated period is due, the bank gives back the money at the end of the period together with the interest. So at the end of the period, the bank will give back the money and the interest to you. But if you as a customer, you want to reinvest the money, then you do so. You can either reinvest the capital or reinvest the interest. That is your choice. But like we said, with the fixed deposit, until the stated period, you cannot go and cash any money out of it. You have to wait until the period, and then you get both the money and the interest. That is the fixed deposit account. Then the savings account or the short-term savings. Money can be paid in a bank or financial institution as savings in the commercial banks, credit unions, and then some building societies. Now, each requires a minimum sum of money to start a savings account, and then an account opened. All deposits and withdrawals are recorded, and then interest is paid on the amount deposited. And the rate varies from time to time, and then the interest is also paid on the minimum balance each moment. So with the savings account or the short-term savings, there is a minimum balance you need to keep in your account, and then each money you pay is recorded, and then each deposit you also, each withdrawal you also make is also recorded, and then interest is paid on it, unlike the current account that there is no interest. With the savings account, there is interest. And one thing about the savings account is that there is a minimum balance you must not go beyond. You can cash the money, but you can't cash everything in it. You have to leave the minimum balance in your account at all times. Unless you want to close the account, you must make sure that all the time you leave the minimum balance in your account. Any questions so far?
Madam.
Yes.
Yes, madam.
Go ahead.
Madam, please, what if I want to close my account in that bank? Is it even possible to close account?
Yes, it's possible. It is possible to close your account.
So what if I want to close account in a bank where you have to keep a fixed and you must not withdraw and beyond that a specific balance?
That is the fixed deposit you are talking about. If you want to terminate that, you go and talk to your bankers, and they will give you the right advice. Even if it's a savings account and you want to close the account, you go to your bankers, talk to them, they take you through the process, and then by all means they will take some charges out of the money you have, and then they will give you the rest of your balance.
Madam.
Yes.
Madam.
Yes.
Madam, what if like the fixed deposit?
Okay.
what if the fixed amount, like the money that you are putting in the bank, the fixed amount is not up to, as in the money that you have set to deposit up to is not up to, by the time is due, would they give you the money?
With the fixed amount, fixed
Yeah.
deposits, they have a fixed
Yes.
amount. For instance, you are given option. Let's assume that you can pay, let's say from 500 cedis and above. So you cannot pay
Yes.
less than the 500 cedis into a fixed deposit account. You get me?
Okay.
So once it is fixed, the amount
Okay.
you are supposed to pay ranges from a particular amount depending on your strength as a client. And one thing you must notice that
Okay.
with the with the savings account, you see, we learned that with the current account, when you are operating it, the check, you can use it to pay your debt, provided your customer is willing to accept, provided your customer is willing to accept your check. But in the case of savings account, you cannot sign a withdrawal leaflet for somebody to go and cash. It is you, the account holder, who have to cash and then pay back. You get that point? Okay, so now let's look at some differences between current account and savings accounts. Now, one, we've said a number of them, so we are just going over. A checkbook is used by the customer in operating his or her account. That is the current account. But with the savings account, withdrawal booklets are used by the bank in operating the account. So if you want to withdraw money from your savings account, you will use a withdrawal booklet, which I said that one it cannot be cashed by a second person unless you, the account holder. And then two, an account holder pays, that is with the current account, an account holder pays service charge to the bank. But with the savings account, interest is paid on a customer's account. So with the current account, you, the account holder, you are charged for the services that is rendered. But for the savings account, an interest is rather added to your account. Then the third one, with current account, the customer can withdraw from his or her account as many times as he or she pleases. So with the current account, you can withdraw at any time, any day. But with the savings account, an account holder has a limited period of withdrawals. So you cannot exceed the minimum balance. That is with the savings account. Although with the current account too, you cannot. But the current account, you have some benefits. You can withdraw everything. But with the savings account, you cannot. So you have a limited period of withdrawals with the savings account. And then another difference is this. With the current account holder can either go personally or issue a check for payment to be effected to another person. So with the current account, you don't feel like going to the bank. You can sign, Ruth can just sign the check, give it to Michael to go and cash for some services. But with the savings account, you cannot do that. You have to go in person and cash it yourself. Then again, with current account, the account holder can enjoy an overdraft facility overdraft, you can enjoy an overdraft facility. That is if with the overdraft, for instance, you have a bit of credit to enjoy. For instance, they know that your salary will by all means hit your account by this time. If you go and then talk to your bankers, they can give you some money, then immediately the money hits your account. But it's a short period, they deduct it. But for the savings account, the account holder is not going to enjoy any overdraft facility. So these are few differences between the current account and then the savings account. Any question?
Madam, please, do you get interest on both, like the current account and
The
the
current
savings? Do you get
account, like
interest?
we said from the beginning, you don't get any interest. Rather, they charge you. They charge you for the services they are rendering to you. It is rather the savings.
So, madam, can that one also be a difference?
Yes, it's a difference. In fact, that was the second point I gave. That with current account, an account holder pays service charge to the bank, but with the savings account, interest is paid on the customer's account. So it's a difference between current account and then savings account. Are you clear with that?
Yes, madam.
Yes, madam.
Okay. Okay, we are still on planning for future financial security. So now we are going to talk about social security. Social security. Because we said it is a way employers, both employers and employees, save some money towards their retirement or when they are no longer working. Now, the basic objective of a social security scheme is to adequately provide income protection for individual contributors when they are no longer able to earn a living. And this could be at old age or invalidity or sickness or loss of job, or provide something for dependents. So the contributors who, as the breadwinner, might have died. So the social security, you don't only enjoy it at old age, but if somebody is a contributor and the person did not attain the age of retirement before death, the person's beneficiaries will enjoy that benefit. So, for instance, the breadwinner of the family just dies. Once you have a proof, that is with a death certificate to prove, you go through the process, and then whatever money that the deceased contributed during his or her lifetime will be paid to the dependent. And the dependent in this case could be the children or people who depend on the deceased person. Now, the social security scheme is a contribution based on a percentage of your salary, and the rate is 5% by the employee. So the employee, which is the person working, pays your 5% of your gross income is taken. Then the employer will also add between 12.5% to 18. Between 12.5% to 18% is paid by the employer. And this is paid on monthly basis until you get to the age where that money becomes helpful to you, or you attain the age that's age 60, where you can no longer work. So it is based on your salary, the salary you take. Now, the money is paid to, initially it was the Social Security and National Insurance Trust, that is SNIT. But now this amount is divided into two. I'm sure you've heard about this tier 2. These days, all that amount is not given to SNIT, but rather part of it is given to them, and then part of it is also given to other insurance companies so that they will run it. So when they will use it, they invest it at your old age. This whichever company is taking the tier 2 for your organization, you get some aspect from that place, and then SNIT will also add the rest, so that when you attain age 60 or you attain age 60 and you can no longer work, there is something for you. Sometimes you go to the bank, especially at the end of the month, you see elderly people there coming to take their monthly pension schemes, pension money. They either give you a lump sum, they will give you a lump sum and then gradually pay the rest in bits. So it depends on whichever plan that was chosen by your organization. And for government workers, mostly it is the pension and then the social security and some other organizations too. So with this social security, you cannot go to SNIT and say that, SNIT, give me part of the money I have contributed because I don't have money and I'm hungry. No, it is not done that way. They will be taking the money once you have registered with them. That money will be deducted from your salary, that is your gross. So you go on retirement. Now, the question is, so what about self-employed people? If you are self-employed and you still want to make this plan, you can just walk to any of their offices, have a discussion with them, and they'll give you the plan. Then you go on a monthly basis, you go and pay, so that you also know you are saving something towards your future. So at the end of your contribution, or when you get to age 60 and you go on retirement, when you cannot do any active work, you will then receive all your contributions with the interest at that time. So that is when your money is ready for enjoyment. That's your social security. When you are 60 years, you go on retirement, you can no longer work. And you go on retirement on your 60th birthday. So somebody who turns 60 today, it means today marks that person's retirement from work. Then the next one we'll talk about is pension. Pension. Employees of the government and other organizations which have pension plans for their workers, they also contribute about 5 to 6% of their monthly salary or wages towards their pension during their working life. So as you are still working, between 5 to 6% of your monthly salary will be paid into a pension fund for you. And the contributor must have worked for a period of not less than, you must not work less than 20 years. You have to work for 20 or more years before you qualify for pension and gratuity. With the pension, a lump sum of money, which is normally referred to as the gratuity, is given to the worker at the end of the person's work. So at the time that you go on retirement, when you can no longer work, a huge sum of money will be given to you. And thereafter, you receive amount of money every month until you die. So if you go on retirement, the pension, you are given a lump sum, and then a percentage of it will be given to you each month.
Madam,
Yes.
please, is it like that in the public sector too?
Sure, that's the public sector. Or you are asking about the
I mean the private. I mean the private sector.
private sector. It depends on every organization and then the plans they put in place for their employees. Yes, some private sectors have this plan, others don't have it. In fact, some private sectors don't even pay SNIT for their workers. And it is the right of every worker that this should be paid, this social security. So if you are working in an organization where they don't do this for you, they don't pay it, you have every right to complain. And then the necessary or appropriate authorities will take them on and they will start paying it. So you can report to, I think, Trade Union Congress. They can help with that because it is your right. So as you are working, they need to pay that percentage and then take a percentage of your money and pay as well. That is if you are not 60 years. So that when you attain or when you get to that age, you will still have something to depend on. Any question again?
Yes, madam.
Okay.
Madam, please, the money they are giving on pension, does the money reduce when they are giving like every month?
With that one, when they give you the huge sum, it depends on the gross you were receiving whilst you were working, because they take a percentage of that. And remember, we said during your working times, they will take 5 to 6% of your earnings monthly. So when you retire, they will give you about 70% of your earnings. Then the 30% that is left, it is assumed that they invest it, and then the total amount will depend on how long the person worked. So the total amount you will receive, even as a lump sum or on monthly basis, will depend on the number of years you worked and then your gross, the amount you were receiving as a worker. So everybody will not receive the same amount of money when he or she goes on retirement. It depends on the number of years you worked and then the amount of money that you were receiving as salary whilst you were working. Are you okay?
Yes, madam.
Okay. So the total amount of money you will receive will depend on how long you worked or how long the pension money was paid into your investment accounts. Then the last one is superannuation. That one too is just like the social security. Both the employee and the employer will contribute 5 to 6%. And just like the social security, 5 to 6%, and then the employer, as usual, have 17.5 to 18% towards the scheme respectively. So that contribution will also be there, and you receive it as an end of service benefit in a lump sum pension. So with the superannuation, that one you receive it just in lump sum, but with the pension, you receive part of it as a lump sum, that's 70%, and then the rest of the 30% will be given to you on monthly basis until you die. So once you receive the lump sum, even if you are going to be on it 90 years for the rest of your life, you continue taking something at the end of the month until you finally die. That is how the pension scheme works. But with the superannuation, you are just giving a lump sum.
Madam,
Yes.
please, what if I travel far from the country? Will I still receive that money, the pension money?
If you still contribute, yes. But if you terminate it, let's assume you've worked up to 20 years before you left, you still qualify for it. You must work for a minimum of 20 years before you can qualify for that. Remember, we said even self-employed people can also do it. They work there themselves and then do the contributions. So if you travel, you are still paying that, you still get it. But if you stop, it means you have terminated the policy. You understand it? Or you are
Yes,
still
madam.
confused? Okay. Now let's talk about insurance. See, we are picking them one by one. First of all, we spoke about savings as an accumulation of funds, and we look at how to save informal. Then we also looked at this pension schemes. So now we are looking at insurance. When we talk about insurance, insurance is basically a protection against financial difficulty resulting from damage, sickness, or death. Insurance is a form of protection against financial difficulty which result from damage, sickness, or death. And it is a way of reducing some of the uncertainties in the family's financial management. Now let's interrogate this a bit. We say protection against financial difficulty. So what it means is when you take a policy with an insurance company, you are paying with the mind that, for instance, if it is a vehicle insurance you took, when your vehicle is damaged, the insurance company should be able to help you get back the vehicle. If the commonest one is the health insurance, when you are sick and then you have an insurance, the insurance covers the payment of all your medical bills, if not all, part or all, depending on the kind of sickness the person is suffering from. And then death. People also take insurances that when they are no more, their dependents can have something to depend on. So it's a way of reducing some of these uncertainties in the family's financial management. Now, there are certain terminologies in insurance. Anytime you hear insurance, you hear some of these terms. Policy. When we talk of policy, is a contract with an insurance company. So if you have a contract with an insurance company, you will say, I have a policy with Star Life Insurance. have a policy. It could be motor, or it could be motor policy, accident. So once you have a contract with such a insurance company, you say you have a policy with them. And then the second term we'll talk about is premium. Premium. Payments made at regular times to the insurance company is what is referred to as premium. So you just say, I'm going to pay my premium, or your policy premium, meaning the regular payments you make. That is a premium. Then we have another term, which is premium risk or risk. When we talk of risk, it's basically the possibility of loss. So you weigh it, risk. How risky is this insurance? There are some policies that you take and then you never enjoy it. You never enjoy it because until insurance policy, like we said, it is a protection against financial difficulty. So until there is a difficulty, you cannot enjoy anything. So the risk, how risky is the policy you are taking? How is it? Then we have policy holder or the insured. The person for whom the policy is bought is the one we refer to as the policy holder. So if it is Agbenyo who goes into contract with the insurance company, she is the policy holder, or she is the insured. Then beneficiary. Beneficiary, when we talk about beneficiary, is the person who will receive the benefit of the policy in case the unfortunate happens whilst the insurance is still in effect. So for instance, if somebody takes a policy, let's say a policy for either you make a policy that when you are no more, the policy should take care of your children's education. Once you die, the particular child whose name you've written there, he or she is the beneficiary. He or she will benefit from the policy you have made because it is his or her name that you use, that he should benefit from that policy when the damage occurs. Another term is face value. Face value is the sum or the amount you want to pay to the company at the time that you want, or the purpose. And this is paid at the end of the period with interest to you. So the amount of money you chose to pay, for instance, they have different rates. If you go to the insurance companies, they have different rates to be paid for each policy. So if you agree that, okay, they have a rate 20 cedis, 30 cedis, 40 cedis, depending on the risk of the policy you are taking. The amount is based on that. So if you choose to pay 50 cedis every month, you will be paid based on that, the face value of 50 cedis per the period you have paid, or the amount that is supposed to be paid to you plus that interest. So the face value will be paid with the interest or the beneficiary if the insured dies. Then cash or loan value. The cash or loan value is the amount that can be attained anytime the policy is terminated before time. So if you want to terminate your policy or you want to discontinue your policy, you are no longer interested, the money you can get is what is referred to as the loan value, cash or the loan value. Any question on the terms?
No, madam.
Okay. Then we'll be looking at some types of insurance. We can talk about two main, but under these two main, we have a lot. We can talk about property insurance and then life assurance. With the life assurance, it protects against loss of income due to death. That is, if a family's chief breadwinner should die, there may be a sudden need for money. So there will be debt to be paid, and then dependents will need support. So life assurance protects against these problems now. But this can only be enjoyed if the policy is still active whilst the insured person dies. But if you terminate it, let's assume your father told you that I have taken a policy for your university education so that if I am no more, that money can take care of you. He told you that he started paying and then along the way he stopped, but he didn't inform you that he has stopped. The policy is no longer in force, so you may not get what you want because the policy has been terminated. But once the policy is in force, when the unfortunate happens, the beneficiary will be given whatever is due him or her. Now, so the person, like we said, the person receiving the money is called the beneficiary, and then death benefits may be received in one lump sum or in monthly installment, and that depends because there are two categories of the life insurance. We have the term or temporal assurance and then the permanent assurance. So it depends on which policy you took. And the term assurance, the individual's life is insured against death for a certain period of time or the term that is given. And the most common terms will be 1, 5, 10, or 20 years. So at the end of that period, the policy terminates. So you need to redo the policy again. And then the benefits are paid only if the policy holder pays up till the time the unfortunate thing occurs. You don't expect to pay up till some time, you stop, and then you are in trouble. You remembered that 17 years ago you started an insurance policy that you only paid for some few months and stopped. Then you go to the company, they will not mind you. They will not mind you. So the term assurance has the advantage of offering low prices to families in the early stages of the family life. But the cost generally goes up if the insured gets older and has greater chances of dying. So you realize that when you are taking an insurance policy for an elderly person, the premium you pay is much higher because it is assumed that the elderly person can die at any time. Although death is inevitable, it comes at any time. Elderly people may be there and then the younger ones will go. But that is the assumption. So normally the premiums paid for the older people, or you start it very low, but as you get older, you need to pay much more because of the risk premium. Then the permanent life assurance. The permanent life assurance. Now, in addition to the death insurance, a savings account increases in that one throughout the life of the policy. And if the policy holder dies whilst the policy is still in force, only the death benefit is paid. However, if the policy holder survives the policy, it serves as a kind of savings account. So if you die, the benefit will be paid. But if not, whatever you have will serve as a savings for you. And then the policy is in value with each premium payment, and this savings normally is permanent for an entire life. So as a policy holder, you have several choices regarding the cash value. You can either borrow part of it or you use it to pay your premium. For instance, there are some insurance policies that if you go through the year, you pay everything and then nothing happens, they give you part of your premium as a profit, or you either use that one to pay the next premium so that you don't use another money in paying, but what has been given to you as a profit on it, you use it to pay. So you don't need to send any money. Because let's assume you made a policy up till this time, and then the time came, but nothing happened. So the money is just there. You can borrow part of it and use it, or you can use it to pay your premium, or you can also convert it into a retirement income. Or some companies can also give it to you in lump sum. So the cash value is sometimes referred to as the living benefit of life insurance. And the longer you have paid, the greater will be the cash value. That is for the permanent life assurance. And with the permanent life assurance too, there are three main types. We can talk about the whole or straight life assurance. This one offers protection for life once you buy the policy, and it is cheap because the premium do not increase as you grow older. That is with the whole or straight life insurance. We say that policy is cheap because you don't pay higher when you grow older. And then the policy builds cash value which can be borrowed or withdrawn. So the policy is like serving as some savings for you. You can either borrow or you can withdraw some of it. Then we also have the limited life assurance. The limited life assurance will also protect you for a specific period of your life, and the premium is for a predetermined number of years, usually from 15, 20, or 30 years, and cannot take a limited life insurance policy after 60 or 65 years. So once you are 60 or you are 65, you cannot take this policy, this limited life assurance, you cannot do it because you are supposed to contribute for a predetermined period of either 15, 20, or 30 years. So if you are 65 plus that 15, that will give you 80. If you are 60 plus 20 years, 100. And at that age, it is believed you cannot work to pay the premium. You are weak. Even if you be alive, you can't do any active work to pay the premium. And you may, and again, at that stage, 60 years, you may take the premium, you just pay for 3 months and then you are gone. So the risk is high for them. So you cannot take that kind of policy after 60 or 65 years of age. And the cash value will grow faster than other types of policies. Now, the limited life assurance policy. The limited life assurance policy that they can be paid for when it's still higher because you will still be working. You can pay for it and then you still be working, and you will also have more period without paying premium when you retire and have less income. So that's the reason why they say if you are 60 and above, you cannot take that one because at that time you can't do any active work and be paying. And there's another one called the endowment policy assurance. Endowment policy assurance. It is also a form of insured savings, and the policy holder will make payment for a certain number of years. And after that period of time, the policy holder receives the face value of the policy. So if the policy holder dies during that period of time, the beneficiary will get the value. And normally, any insurance policy at all you take, you'll be asked to give names of beneficiaries, that when you are no more, this or that person is eligible to take your claim or claim whatever you have contributed for. So you need to save a definite amount for the future. And apart from the basic types of life assurance policies, there are others. Like I told you, there are other policies like the property insurance, the car insurance, property damage liability, comprehensive physical damage. You can talk about the comprehensive physical damage insurance as well. Then also we can talk about child's education policy. With the child's education policy, it is a savings scheme for parents towards their children's education at a higher level. And this also guarantees continuation of the children's education if the parent who took the insurance dies. So you remember from the beginning, I said your parents can make a policy for you that when he or she is no more, that policy will take care of you at your higher level of education. So this is the children's education policy. So the insurance company takes charge of the school fees until the age that has been indicated in the policy. So looking at the policy, for instance, if the policy states that you should be taken care of till you complete your second degree or first degree, then that is how the policy will work. Once the person who took the policy for you dies, you will not struggle for fees. It means the insurance company will take up that mantle because your father or mother took such a policy in your name whilst he or she was alive. So once he or she is no more, the policy must take effect. Then property insurance. Property and family can be protected by buying several different policies of coverage. And the most common are fire, theft, and liability insurance. Let me just use this Star Assurance advert. You see, it's 3 families. They were all robbed. When they went out, came back, and they realized that their homes were broken into. All the other 2 families were worried because they have not insured their property or they've not insured their home. But the 3rd family that insured their home, the insurance company came to their aid because of that policy they had with the company. So that's basically about the property insurance. So you can choose to insure your building, or you insure against theft or fire outbreak. But mind you, the fact that you are taking an insurance policy doesn't mean that you deliberately do something and then you call the insurance company and they will just give you that support. They also do their investigation. So don't think that I have a car insurance policy. My car is about 20 years old. I want it changed. So you intentionally set fire to it or do something stupid, thinking that once the car is spoiled, you have a chance of getting a new one. No, they do some form of investigation before they pay the claims. So the liability insurance will protect from accidents that happen to someone in your home, and it protects you against lawsuits or claims filed by somebody who will blame you for their injury or damage to their property. And one of this is car insurance. One of the property insurance, we can talk about car insurance. The car insurance, you see vehicles, being it private or commercial, they all have insurance policies. Sometimes you've heard people say that people are involved in accidents and then they get some form of insurance cover. Once the the vehicle that was involved in the accident is insured, you get that cover. So it will protect you against various forms of damage caused by the vehicle. So that if the car is insured and you are involved in an accident, what it means is the accident to take care of your hospital bills. Then we can talk about bodily injury liability. This one applies when your car or vehicle injures or kills pedestrians or people in other cars or passengers in your car. And it applies when the holder or a member of the immediate family or another person under whose permission you drive. So the car may not be for you, but you have an authority to drive that car. Once it is involved in an accident and the car is insured, the insurance policy will also come in and then take charge. And this liability insurance protects the insured and then claims or suits of people injured, of people's injuries, or people that are killed by the insured car. So even if the person is killed or loses his or her life, the insurance company will have to compensate the person who died or the person who is injured. The medical bills will be taken care of. So what this means is that either you sit in the car or the vehicle knocked you down by the roadside. Once it is insured, and then it is not through negligence, you would get that, you'll be able to get your claim. And again, it doesn't mean that because the vehicle is covered, when you take more than the number of passengers you are supposed to take, the insurance will take charge. No, it will not. So you have to work on that as well. Okay, so we'll end it here. If you have any questions you can ask. We'll meet next week. We'll continue from where we have ended. Any question?